Did you know that the price of cheese futures just plummeted over 20% since June? Investors are outraged, and even the S&P 500 has been on a grueling downtrend these past few months. As a fellow professional money burner, or investor as some of you might like to call yourselves, I have to say that our job just got a lot easier. Nah, but seriously, we might be completely screwed and we don't even realize it now. There is a decent possibility that we're currently witnessing the biggest bubble in history, with some investors like Michael Burry even stating that everything, and I mean everything, is overvalued. And if you think about it, it's not such a far-fetched idea. It wasn't that long ago that we saw virtual apes trading for millions of dollars. We haven't even talked about inflation yet, which is absolutely crippling household income, and with another Fed meeting soon, we might be subject to an unpleasant surprise in the form of a 100 basis points rate hike, which the market is actually starting to price in. But before we talk about inflation and interest rates, we have to talk about the Black Swan event that happened 2 years ago and caused this mess today. The Great 2020 Toilet Paper Shortage. A moment of silence for all the people who had to use corn when going to the bathroom. Okay, I'm actually talking about the complete economic collapse of 2020 because of the pandemic, when US unemployment shot up to almost 15% and the S&P 500 dumped 35% in a month. That's when one of the biggest bailouts in history took place, when the US money supply almost doubled in a year. That's the power of quantitative easing. Now, if you don't know what QE is, it's basically the Fed buying assets and injecting new money into the economy in the process. Obviously, it's more complicated than that, but let's be honest, we don't have patience for that. We just want to become rich overnight, YOLOing our paychecks in risky trades that have a 99% chance of not going our way. So let's continue. The Fed stimulated the economy so hard that despite supply chain issues or other lockdown related problems, markets pumped like crazy until this year, when suddenly the effects of printing more money in a year than in 2 centuries of the US's existence caused inflation to spike. Who would have thought? Take a look at the S&P's chart. You can see the massive 50% pump from the lows of 2020. But look at this chart now. This is the S&P divided by the US money supply, and it paints a completely different story. We've just reached the same level we were at the peak in 2020. Insane. Injecting money in the economy can only take you so far and will never beat organic growth. The sad truth is that we were saved from a recession back then just so that we can experience a depression today. Okay, that might be a bit too ominous, but we have to be cautious. The minute you FOMO all of your funds into the market without proper due diligence because you think the bull run's back on is the minute you donated money to Wall Street. But here comes the really bad news. This time inflation will probably get under control only after the unemployment rate rises significantly, which is why the market reacts so badly right now when the US jobs report comes out and there are like hundreds of thousands of jobs being created every month, because consumers will consume until they can't consume anymore. In a nutshell, inflation is so bad that only a recession will likely bring it back down. This is what happened in the 70s and the 80s when Volcker hiked interest rates to astronomical levels. Jerome Powell seems keen to follow Paul Volcker's solution to soaring prices. He said it himself at the Jackson Hole speech. Getting inflation under control is the #1 priority of the Federal Reserve. And this is just the US. Inflation in Europe is much worse, also because of the energy crisis. So let's take a look at the 3 levels of pain for the markets. This is just how I would describe the situation. First, we have the pre-pandemic high. If this is the bottom, then we can consider ourselves very lucky. I would almost call this a soft landing. Then we have the second level, which is the March of 2020 lows. Now this is where it gets serious because this would mean a 54% drop. For reference, the mortgage crisis in 2008 was a 57.5% drop. Not good, obviously. That was a period of financial hardship for many people. And then we have the third level, which I would consider to be a drop of 60% or more. At this point, this can be a full-blown depression. We got one 100 years ago, and some like Jeremy Grantham are even saying that this is when we get another one. The Great Depression saw the Dow Jones decline almost 90%, which is just mind-boggling. I am not even joking, I get goosebumps when I look at this crash. Now this is pretty scary. But what I also want to highlight is that if the stock market survives something like that, it just goes to show that in the long run, stocks do go up. Unless you bought one of the many companies that probably completely collapsed. That's why you diversify your portfolio. Very important. Don't put all of your baskets in one chicken. Real talk, if you don't have an appetite for risk, a healthy approach is to just invest a portion of your disposable income regularly, so money that you can afford to lose. Oh, and of course, none of this was financial advice in case it wasn't obvious enough. So anyway, I hope you enjoyed the video, leave a like and subscribe for more.